Hi everybody, I'm Sidney McKinnon, MD and CIO of Cadiz Asset Management, and welcome once again to our channel of all things fixed income. I think one of the important things, or one of the most important factors when looking at fixed income investments is interest rates, because I think that's within the name. We call it fixed income or fixed interest, and effectively the important thing about interest rates is how they would affect your investment as a fixed income investor. Now, where does this come from? What is so important about interest rates? I think the origin in terms of interest rates affecting your fixed income investments comes from the fact that monetary policy is set largely by governmental institutions such as central bankers, who have a committee, normally a committee that they form, which then goes and sets policy and implements that policy as well. So what is this monetary policy all about, and why is it so important for fixed income investments? First of all, the Monetary Policy Committee within a central bank has an important job of controlling or attempting to control or to facilitate the way in which the activity plays out within an economy. I'm talking here about price fluctuations. I'm talking about the rate of inflation within an economy, and the volatility that you might expect around things like the currency within any economy in the world. So the Monetary Policy Committee has really got this job to set policy and then implement it. But how does this translate to interest rates? Now, the Monetary Policy Committee, or committee that's set up by the central bankers, have many tools at their disposal in order to control, as I mentioned early on, economic activity, inflation within the economy, volatility in terms of price fluctuations. So one of the important tools that they do have in their toolkit is to set an interest rate. Now, we all know about the interest rate that gets set, particularly here locally within South Africa, called the repurchase rate, or commonly known as the repo rate. And effectively, that rate is the rate that the central bank uses to lend money to commercial banks. And of course, the commercial banks then in turn lend on to you and I as retail investors or retail borrowers. And they obviously will then increase that rate in order to become viable as a commercial bank. So the origin, as I mentioned, is set by the central bankers in terms of the repurchase or the repo rate. Now, why are they doing this? How does this tool actually work? The tool works in the sense that if an economy is stalling or an economy is slowing down too quickly, stimulus needs to be brought back into that economy. And a very clear example, or a very recent example, was when we went through the COVID pandemic. Our economy suddenly started to slow down dramatically. So the central bank committee or the central bank had to lower rates in order to stimulate activity within an economy. Because ideally you want an economy to run at an optimal rate. And on the converse, if the economy or inflation is starting to tick up or rise above levels which is sustainable, then the Monetary Policy Committee or the central bank can use the tool of interest rates by raising interest rates. In other words, then starting to cool down the economy by slowing down the activity in terms of price fluctuations. How does this then affect us as an investor within the fixed income environment? I think the important thing is two things. Let me say, the important thing is two things. The first thing is that it affects you as an investor, and the second thing is it affects you as a borrower. So it depends whether you are investing or whether you are borrowing. We all have instances where we perhaps borrow funds to fund a purchase of a home, such as a mortgage, or then to pay the installment on an installment lease on a car. And interest rates are rising, then that's when it hurts us because we have to pay more. So as a borrower, rising interest rates is not great. When the rates come down, that's great for you as a borrower because you're going to be paying less interest from the institution that you are borrowing from. But if you are an investor, rising interest rates might not be such a bad thing, because if you're putting a deposit in a bank, for example, and you're earning more interest, hopefully more than inflation, so you're not going backwards, then rising interest rates is not such a bad thing. But let me put a word of caution in the sense that in the fixed income environment, if you're investing in the fixed income environment, there are many types of investments that you can do. The most common is putting money in the bank, such as deposit, and if interest rate goes up, great. Comes down, obviously less great. But then you can also invest, as I mentioned in one of our previous sessions, in instruments such as bonds. And bonds or government bonds that you invest in actually has a inverse relationship with interest rates. So if interest rates rise, your capital can be eroded, depending on the extent at which they rise. If interest rates drop, your capital can actually then grow and expand. So within the fixed income environment, as an investor, you have quite a bit of variety. I've only mentioned two, deposits and bonds, but there's quite a bit of variety that you can get involved in to use the way in which interest rates moves. Remember, the importance is the directional movement of interest rates. To use that directional movement of interest rates, if you can anticipate it, to your advantage. So I think that what we're trying to establish and what we're trying to say is that as interest rates change, as interest rates are set by central bankers, it's going to affect you as an investor. It's going to affect your investment, whether that be positively or advantageous, or whether that affects it adversely or negatively. So the important thing is to do your homework, find out as much as you can, research as much as you can, and in that way you can become a wise or maybe a more informed investor when investing in the fixed income environment. So thank you for watching, and please tune in again, once again, when we speak about all things fixed income. Thank you.